In Chapter 2, we will be looking at a way to cost a product called job order costing. Job order costing systems are used when you produce many different products each period, or when products are manufactured to order. The unique nature of each order requires tracing or allocating costs to each job and maintaining cost records for each job. So some examples of companies that would use job order costing to determine the cost of their products would be Boeing, Bechtel International, and Walt Disney Studios for movie production. And not only can it be used to determine the cost of a job or a product, it could be also used to determine the cost of a service. So please keep that in mind. Although our focus will be on the jobs. So there's job number 1, job number 2, job number 3. We talked about direct costs in Chapter 1. So direct costs, remember, are those that can be easily traced to a particular job in this order. So direct materials. So you can tell exactly how much direct materials are used for job number 1 or job number 2 and job number 3. And the same with direct labor. What was the total labor used for job number 1, job number 2, job number 3, and this is the direct ones. Then the other costs, the indirect costs, or what we call manufacturing overhead, are indirect materials and indirect labor. So those materials and labor costs that you can't trace specifically to a product, not easily anyway. And indirect other costs, such as utilities and taxes for the factory building, depreciation on the equipment used in the factory or the job itself. These are then allocated. So we come up with a total dollar amount of these items and we allocate the amount to jobs rather than directly tracing to each job. And we're going to show you that process in this chapter. We use what's called a job cost sheet to trace all costs of a product. You'll see that this goes by job number, department, the item they're tracing the cost for, the date it started. The middle row of columns is the amount of direct materials, the amount of direct labor, and then the manufacturing overhead applied. And then we add up each of those items in the cost summary area below to get a total cost and a unit product cost. So measuring direct materials costs, and you saw from your chapter, this is on page 70, there may be a bill of materials. This lists the types and quantity of each type of direct material needed to complete a product, a job. Okay, and when we begin the process of doing the job, building this item, A143 is the job number, we request through a material requisition form the direct materials needed. This would be taken to where the inventory is controlled, and then the materials would be released for the job. These costs, direct material costs, are shown right on our job cost sheet in that particular column. The next is the direct labor costs associated with the job. Now, when an employee is working, they are going to show the start time and the end time for a particular job on their time ticket and what they worked on. So they worked all 8 of their hours on that day at $11 an hour on job A143. So these are the workers directly working, putting their time in on the job, and it could easily be traced to them. We would then update in the direct labor column the ticket number of the time card, time ticket, the number of hours worked, and the total amount of direct labor. Notice it's job number A1-43, and on the previous slide we saw that's what the employee recorded. So far we have direct materials, cost summary of 116, direct labor of 88. Now we'll move into the manufacturing overhead. Excuse me. When it comes to manufacturing overhead, we actually estimate or compute a predetermined overhead rate. So we allocate, and we use an allocation basis. We pick something that we could measure by product, maybe direct labor hours, direct labor dollars, machine hours, okay? And these are used to assign manufacturing overhead to individual jobs. So we use an allocation base because it is impossible or difficult to trace overhead costs to a particular job. Manufacturing overhead consists of many different items, ranging from the grease used in the machines to the production manager's salary. Many times sub-manufacturing overhead costs are fixed, even though output fluctuates during the period. Things like rent, heat. So what we do is we determine a predetermined overhead rate. How we do that is we estimate total manufacturing overhead costs for the coming period. How much do we think we're going to spend on these indirect costs? How much? Some of them we know already. They're fixed. We'll look at how we determine and take a look at the variable in a few minutes. But we determine an overall total manufacturing overhead for the period, and then we divide that by the estimated total units we decided to use in allocating the base. That could be hours of work, it could be labor costs, it could be machine hours. Okay, so we have to find some type of allocation base and determine the total number of units we expect for the coming period. When we do that, we then determine an overhead per labor hour, an overhead per dollar of labor, an overhead per machine hour. So predetermined overhead rates are needed, and they do rely on estimated data. Why? Because actual overhead for the period is not known until the very end. So you really can't determine your overhead costs as you're going or working and completing different products or jobs or services. And actual overhead costs can fluctuate seasonally. So this could mislead us when we're making decisions. So we come up with a standard or predetermined overhead rate based on estimates. We try to estimate as close as possible to actual. Now, again, when you're computing your predetermined overhead rate, you do it before the period begins. You use a four-step process. The first is estimate the total amount of the allocation base, the denominator. How many hours are you going to work if that's your allocation base? How many dollars of labor if that's your allocation base? How many machine hours? Then you're going to estimate your numerator, which is the total manufacturing overhead costs. But the way you have to do that is you have to estimate your fixed manufacturing overhead costs for the coming period and add your variable manufacturing overhead cost per unit of the allocation base. And then determine your total amount of manufacturing overhead estimated by taking your estimated fixed plus your estimated variable times that total amount in your allocation base in the denominator. Add those two together, that is your estimated total manufacturing overhead. Complete the calculation by dividing your denominator into the numerator, and that's going to give you your predetermined overhead rate. Now, before I go into the next one, they have a great example of this in your book. It's on page 74, just so you could run through with the numbers. They're talking about Yoast precision machining. And in step 1, now these are all assumptions that are being made. The company estimates that 40,000 direct labor hours would be required for their production for the coming period. They already estimated and determined their fixed overhead would be 220,000. And their variable manufacturing overhead would be $2.50 per direct labor hour. So what is the total estimated manufacturing overhead costs? Well, you're going to take the fixed overhead estimated plus the estimated $250 per direct labor hour times 40,000 direct labor hours that are estimated. So your numerator, total manufacturing estimated cost, 320,000, divided by the estimated direct labor hours of 40,000, and you would get $88 per direct labor hour. Okay, so then when you apply your overhead, Pear Company estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. So another example, that's the same example? Yeah, it's a little different. In addition, the company estimates total fixed manufacturing overhead. Now be careful, look at that word fixed. So it's only part of it, 200,000, and variable will be $2.75 per direct labor hour. So the total estimated manufacturing overhead would be the 200,000 fixed plus the variable of 275 times the 160,000 direct labor hours they're expected to have. So in total, 640,000. They would then divide that 640,000 total manufacturing overhead they expect by the estimated direct labor hours of 160,000. So their predetermined overhead rate will be $4 per direct labor hour. Now, when they are finishing up job A143, they could calculate their manufacturing overhead for this product by taking the 8 hours of direct labor hours times the $4 of predetermined overhead rate. So total manufacturing overhead allocated to A1-43 would be $32. And that's how we apply manufacturing overhead to a product, a job, a service, based on estimates. Now, how do we compute the total cost and average cost per unit of a job? Well, we then add up on our job sheet all the direct materials, plus the direct labor, plus the manufacturing overhead applied, and we get a total cost of $236. Sorry, I went forward. I think this was making 2 products. So if you take $236 divided by the 2 products, you'll get a cost per unit of $118 each. So let's do a quick check. Job WR53 at NW Fab Inc. required $200 of direct materials, 10 direct labor hours at $15 per hour. The estimated total overhead for the year was $760,000, and estimated direct labor hours were $20,000. What would be recorded as the cost of job WR53? So I have my calculator out here and take a few seconds here and see if you got it. So we got $200 of direct labor hour. Easy, right? We know that's definitely. Now we would have to calculate the total cost of direct labor by taking the 10 hours times $15 an hour, $150. The next step is to determine your predetermined overhead rate. where we would take the 760,000 estimated total overhead and divide it by the 20,000 direct labor hours. We would get $38 per hour. We already know there's 10 direct labor hours associated with job WR53. So we'll multiply the $38 times 10. So $380 would be applied to this job, but that's not the total cost of the job. The total cost would be that 380 plus 200 plus 150. So the answer would be D. And there's the complete calculation as we just discussed it. Now, we know how to, through that process, we saw how we determine the cost of a product and how we use a job sheet and a job costing sheet and where the information comes from, how we calculate the predetermined overhead rate. But how about in our accounting system? How does this all get in there? What's the story? Well, in objectives 4 and 5, first we're going to understand the flow of costs in a job order costing system and our accounting system through journal entries. Then we'll show you how they flow through the T accounts. First of all, we need to define some key areas in a manufacturing environment. Raw materials. This is any material that goes into a final product, whether it be direct or indirect materials. Direct being if you were making a plastic coffee cup, the plastic. The materials could be glue, nails. Those could be the indirect materials. All materials are raw materials. Work in process is inventory that started and only partially completed. Finished goods are the final product, the completed units. Cost of goods manufactured includes all the manufacturing costs associated with the goods that were finished during the period. So those are our key definitions. We're going to show you those items in our accounting system. When we have a manufacturing environment, the raw materials are where you're going to store your materials purchased. Because when you buy materials to be used in production, they're considered raw materials. You didn't do anything with them yet. So we will have an inventory asset account called raw materials. When we move raw materials into the manufacturing process, we take them out of the inventory account raw materials and we put them, the cost of those materials, into another inventory account asset called work in process. We will also increase the work in process account for any direct labor used during the manufacturing process for that product or job. We will also apply the manufacturing overhead and increase the work in process inventory account for the amount of manufacturing overhead applied to that job or product. When the product is done, all the costs should be in the work in process inventory account. They will then be taken out of that inventory account and put into the finished goods inventory account until they are sold. When they are sold, we remove the cost of the good that was sold out of the finished good account and into the expense account, cost of goods sold. Any normal period costs are listed as selling and administrative. So that is how costs flow. So all those things we saw, direct materials, direct labor, manufacturing overhead. First part of the chapter shows us how to determine them. This part of the chapter shows us how they flow through our accounting system. So the transactions in the T account and journal entry that capture the flow of costs in a job order costing system will be illustrated now. Okay, so don't let that scare you. We'll be seeing them in journal entry form. So when you buy raw materials, When you buy them, you debit raw materials and you would credit cash, let's say, or accounts payable. When you move raw materials into the production process, you will credit the raw materials account and debit the direct material portion into work in process. Any indirect material costs will be credited to the raw materials account and debited to, called a clearing account, manufacturing overhead. In the end, it won't have a balance. We debit the manufacturing overhead account for actual costs of overhead. We credit it for the amount applied, and we'll see that. On October 1st, Smith Corporation had 5,000 in raw materials on hand, so that's where they started. During the month, the company purchased 45,000 in raw materials. So you see the journal entries there. Debit inventory, raw materials inventory, credit accounts payable. The assumption is they bought them on account. Since it doesn't say, that's what they did. So that's our first journal entry. On October 3rd, Smith had 43,000 in, and oh, by the way, what I suggest to do is as we start creating these accounts, make your own T accounts right in front of you. We're going to see them on the slides, but then you'll see them right in front of you as they're actually, the stuff's occurring. So I'm going to do that too. I love T accounts. All right, so I started with my raw materials. It started with a debit balance of 5,000 from the last slide, and I just added 45,000 more. So that's my first inventory account. I'm going to make two more, a work in process inventory T account, and then my finished goods T account, inventory, and then my manufacturing overhead T account. That, remember, is going to be like a clearing account. We debit it for actual overhead, we credit it for applied. So work in process, I moved $40,000 of direct materials into work in process and $3,000 into manufacturing overhead. So I debit the work in process inventory, I debit the manufacturing overhead T account, and then I'm going to credit raw materials for $43,000. We don't have them in inventory anymore. They're in the next step of the process. So that's how we handle material costs. What about labor costs? So we have two different kinds. Remember, there's direct and indirect labor. Direct labor you can associate directly with the item being produced. So you would debit work in process for that dollar amount and credit salaries payable or cash, depending on when it was being paid. In this case, they're assuming it's going to be paid later, so we credit a payable account, a liability. The indirect labor, the maintenance guy's labor in the factory, the supervisor in the factory, their labor is also part of the process, but it's indirect. So we'll actually debit that manufacturing overhead for their portion. During the month, the employee time tickets included 35,000 of direct labor and 12,000 for indirect labor. So I'm going to debit work in process, and I'm going to do that same in my T account for the direct labor. I'm going to debit my clearing account manufacturing overhead for 12,000 for the indirect labor, and then I'll credit a T account salary and wages payable for the portion for the 47,000 that needs to be paid to our employees, and it sits there until they're actually paid. The next part is recording actual manufacturing overhead costs. So as we're paying all those other items that can't be applied directly to our product, things like rent, electricity, heating, depreciation, we will debit the manufacturing overhead account. So during the month, the company incurred the following actual overhead costs. They had utilities of $1,700, depreciation of the factory equipment of $2,900, and property taxes payable on the factory of $1,000. So all of those costs would be debited, these manufacturing overhead costs would be debited to our clearing account, manufacturing overhead, and then you would credit each account. It could be utilities payable or cash, accumulated depreciation, and the property taxes payable or cash, depending on what was transpiring the day we record these amounts. Now, remember, we don't debit work in process for the actual amount of overhead because we don't know it as we're going through the year. We determine an overhead, a predetermined overhead rate, and we apply that amount based on some allocation base, direct labor it might be. When we apply the overhead, we debit work in process for the amount of overhead we're applying, and we credit the manufacturing overhead clearing account with the hopes that the actual and the applied are zero. You know, the difference between them, I should say, is zero if we estimated perfectly. If they aren't equal, we will need to do another journal entry to make them equal. We'll take a look at that. So Smith uses a predetermined overhead rate of $3.50 per machine hour. During the month, 5,000 machine hours were worked, so they'll be debiting their work in process inventory, and I'm going to do that on my T accounts, and crediting their manufacturing overhead, $17,500. There's non-manufacturing costs. They must be assigned properly in the period incurred. Salary expense of employees who work in marketing, selling, or administrative, advertising expenses. So here's Smith incurred but has not paid sales salaries of $2,000 and advertising expense of $750. So you would debit the expense accounts and credit the payables. When we are done with our products, our work in process, and we have a final product or process or a job, we then transfer it, all those costs associated with that product or job, out of the work in process account, and now they become finished goods inventory. And they are ultimately is the cost of goods manufactured. So during the period, Smith completed jobs with a total cost of $27,000. So you will debit finished goods inventory for $27,000 and credit your work in process inventory for $27,000. Finally, when those products are sold, just like you learned in your other accounting courses, you would credit the finished goods inventory for the cost of the good that was sold and debit the expense account cost of goods sold. So Smith sold the $27,000 in finished goods inventory to customers for $43,500 on account. So the company would debit accounts receivable because they were sold on account. The customer owes them the money. Remember, that's an asset account. We credit sales. That's our revenue for the selling price of the goods, $43,500. We then debit the expense account cost of goods sold for the cost, $27,000, and we credit the finished goods inventory for $27,000. So we've created the T accounts for all these items. They would lead us to a trial balance, and then we would prepare schedules of cost of goods manufactured and cost of goods sold and an income statement. Come on. There we go. The schedule of cost of goods manufactured. This schedule contains the three types of costs: direct materials, direct labor, and manufacturing overhead. It calculates the cost of raw materials and direct labor used and the amount of overhead applied. It calculates the manufacturing costs associated with goods that were finished during the period. Let's take a look. On the cost of goods manufactured schedule, you will see we're going to start with beginning inventory of raw materials, add any raw materials purchased, and then subtract the amount that are still in inventory. Remember, raw materials available are everything we could have used in production. If we subtract what we didn't use, what's still left in the inventory, that will give us our direct materials used. We then add direct labor and manufacturing overhead applied. That will give us our total manufacturing costs. Beginning work in process. So our inventory work in process, remember what work in process is? It's all the cost of the items that are started and not finished yet. So, companies don't close at the end of the month or wait till all the products are manufactured at the end of the month so they have zero in work in process to begin the next month. No. So at the end of a month, let's say, there may be items started and not finished. So the next month, that would be the beginning inventory balance. The cost of those items would be still there. We would then add this stuff that was applied for this month, total manufacturing costs. So that would give us our total work in process for the period. We would then subtract the amount of costs started but not finished at the end of the month. And that will give us our cost of goods manufactured. Cost of goods manufactured are the goods that are started and finished. They'll be added to any finished goods beginning inventory. We subtract the ending finished goods inventory for the time period, and that will give us our cost of goods sold. So that's how you flow through a cost of manufacturing and the income statement for a manufacturer. So beginning raw materials inventory was $32,000. During the month, $276,000 of raw materials was purchased. A count at the end of the month revealed that $28,000 was still present. So we're going to add the $32,000 to the $276,000 and then subtract $28,000. And you'll get $280,000. And there's your computation. Direct materials used in production totaled $280,000. Labor was $375,000 and $180,000 of manufacturing overhead was added. What were the total manufacturing costs for the month? We'll just add those three amounts together. $835,000. Beginning work in process was $125,000. Manufacturing costs added to production for the month were $835,000. There were $200,000 of partially finished goods remaining in work in process at the end of the month. What was the cost of goods manufactured during the month? Well, remember, we take the $125,000 beginning work in process, add the manufacturing costs for the month that would have been added to work in process during the month, $835,000. Subtract what's still being worked on, the cost of those items, $200,000. Answer, $760,000. And there's your computation. I'll give you a second to take a look at it. Beginning finished goods inventory was $130,000. Cost of goods manufactured for the month was $760,000. The ending finished goods inventory was $150,000. What was the cost of goods sold for the month? Again, the beginning inventory plus the cost of goods manufactured that was transferred to finished goods, $760,000, and then subtract the costs of ending finished goods inventory of $150,000. So you had $890,000 of finished goods. That's how much they cost you to make them for the period you're looking at. But some of them you didn't sell yet. The cost of those that are still here is $150,000. So you sold goods that had a cost of $740,000. Okay, there is a great example, and I'll make sure in the practice problems we take a look at the statement. It is on page 87. and 89. Okay, maybe we'll have one here. I can't remember when I was looking through these slides. Grade T accounts also, they should be very similar to what you did if you were working along with me. Okay, just so you could see them going in and out of the T accounts. Now what happens if at the end of the period you don't apply all that manufacturing overhead? So I'm going to look at my manufacturing overhead. I had 3,000 of indirect materials, 12,000 of indirect labor, and then 5,600 of those other expenses. 0, 6, 7, 8, 9, 10. So the total amount, if I did my addition right, 6, 7, yep, of actual manufacturing overhead on the debit side was 20,600. I applied 17,500 only. So I under-applied. So under-applied overhead exists when the amount of overhead applied to jobs during the period is less than the total amount you actually incurred. Over-applied is the opposite, when you apply more than you actually incurred. Well, we have to adjust for that. So Pear Company's actual overhead for the year was $650,000, with a total of 170,000 direct labor hours worked on jobs. How much total overhead was applied to Pear Company's jobs during the year? Use Pear Company's predetermined overhead rate of $4 per direct labor hour. Well, their applied was the $4 times 170,000 direct labor hours, or 680. Their actual, $650. So in this case, they applied too much, or over-applied overhead for the year by 30,000. What did they do? Well, quick check, just so you can see this. Tiger Inc. had manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per hour based on 290,000 machine hours during the period. Did they over or underapply their manufacturing overhead, and by how much? Look, their overhead applied was $4 an hour times 290 hours, 1,160,000. Their actual was 1,210,000, so they should have applied 1,210,000. They only applied 1,160,000, so they underapplied by $50,000. So what does Pear Company do? Since they underapplied, they will debit manufacturing overhead. Now I have myself confused. I apologize. This is an overapplied. I couldn't remember if Pear Company over or underapplied. I apologize. When you overapply, you will debit the manufacturing overhead account because your credits would be more than your debits. So we want that account to be zero. So they applied 680,000. So the credit side of manufacturing overhead is where you store the applied amount. The predetermined overhead rate times the labor hours was 680,000. Their actual was 650,000. So to make that account zero, we'll debit the manufacturing overhead for the 30,000. So both sides are equal, credit cost of goods sold. You would do the opposite if it was underapplied. You would debit cost of goods sold and credit manufacturing overhead. Sorry about that. I couldn't remember. What effect will the overapplied overhead have on Pear Company's net operating income? Net operating income will increase. So to this point, we have assumed that there is a single predetermined overhead rate called a plant-wide overhead rate. But large companies often use multiple predetermined overhead rate. They may be more complex, but may be more accurate because it reflects differences across departments. So you just want to keep that in mind. What about service companies? We looked at product manufacturers. Job order costing is used in many different types of service companies as well, following along the same lines. Law firms, accounting firms, and medical treatment. How much did it cost to make that tax return? How much did it cost for that lawsuit? And we would look at the same types of costs. So we're not going to go through an example. We just want to make you aware of it. In our course, we're focusing on the more complex manufacturing overhead, manufacturers of manufacturing overhead on the brain. So I'll be sure to do a problem where we demonstrate the schedules of cost of goods manufactured. That was a nice flow chart, but you got to do it and see it to really appreciate all the steps and requirements of it. So that ends our discussion of Chapter 2. Please be sure to post any questions you may have on our discussion participation board. Come on.